Welcome to Growth Investing Mastery. This video will look at valuing a growth stock. As a reminder, this is not investment advice or recommendations to buy stocks. The topics for this video will include examining growth investing versus value investing and how to measure the value of a growth stock. We will examine why our screening process does not account for value. This was a common question that came up in the stock screening video. Additionally, we'll look at scenarios which can change the value of a growth stock, and we'll learn how to rule out story stocks. We'll next do a deep dive on past successes with using value effectively, and also look at failure cases where value was disregarded. Next, we'll examine common mistakes with using value in growth investing, and we'll look at our strategy on trimming and adding based on value. Lastly, we'll have some concluding thoughts to wrap it up. Let's discuss the concepts with growth investing versus value investing. And most investors tend to fall into one camp or the other. Newer investors typically mix and match growth and value as they explore different investing styles. However, the two styles are not diametrically opposed, as is often believed. A growth investor may inadvertently have a stock become a value stock. And this sometimes happens that a growth stock can get into value territory when the company delivers promising results, but the stock sees no price rise. Likewise, a value investor may have a stock become a growth stock. And this can happen where a value stock becomes a growth stock when a new product is introduced, and that product really starts taking off in the marketplace. For myself and this strategy, I found that the investments I was most excited about were always growth stocks. And my best outsized returns also came from growth stocks. Let's discuss measuring value of a growth stock. And one key observation is that growth investors have no agreed upon way to value their companies. So, depending which growth investor you talk to, some may use price to earnings, some may use price to sales, others cash flows, others relative prices, or even industry comparisons, and we'll talk about the trade-offs between those. However, other investment styles often speak the same language as they figure out the value of their assets. For example, value investors typically use price to earnings ratio to figure out the value of their companies. And with options, they initially get set with the Black-Scholes model, and then traders look how far that option price may have deviated from the Black-Scholes model. With commodities, there's historical trends and ranges. So if coffee beans are at an all-time high, it might mean they're overvalued, for example. And some of the reasons that growth investors often speak past each other regarding value is there's a lot of different aspects that can change the value of a growth company. And we have here a list of points which could change the value of a growth stock significantly. For example, if the revenue growth rate of a company is up 150% year over year, how should that change the value of a stock? What if the company gave new guidance that projects 25% quarter over quarter growth? Or what if a new product just launched and is supposed to ramp up in the next 6 months, adding incremental revenue gains? What if we see in the financials that net income margin is accelerating each quarter over the last year? Or what if we find out gross margin is up 500 basis points sequentially? All of those 5 factors we just mentioned are likely to increase the value of a growth stock significantly. But by how much is the real question. Let's now get into some slightly more technical aspects of valuing a growth stock. Both price to earnings and price to sales measure what we desire in a growth stock. And that's because we want to see accelerating earnings and accelerating sales. And keep in mind, sales and revenue are the same thing. And there's 3 different ways to measure either price to earnings or price to sales on the time frame. We can do trailing 12 months, which is the standard for price to earnings. We can do run rate, which is where you multiply the current quarter by 4, or we can do forward looking, which uses analyst estimates and looks at the next 12 months. And I wanted to give a quick example to look at how run rate works for calculating either price to earnings or price to sales. For the sample company, we have revenue over the last 4 quarters of 50 million going to 65 million, then to 85, and then to 115 million in their latest quarter. We know this company is likely to have revenue of 115 million or more in the coming quarters because it's a growth company and they just got to 115 million. And the way that the run rate calculation works is that we multiply the current quarter's revenue by 4. So we would do 115 million times 4, and that's 460 million. We then divide by the market cap. And since the market cap was in billions or 2 billion, that's 2,000 million. So we do 2,000 divided by 460, and we see the company has a price to sales of 4.35. And one of the drawbacks of using trailing 12 months is that it includes old data. So the trailing 12 months price to sales, it scoops up that first quarter with 50 million of quarterly revenue. However, that 50 million is much less than the company is currently capable of getting in sales. On the other hand, forward-looking ratios are based on flawed analyst estimates. This is because analyst estimates are lazy and they simply calculate or extrapolate patterns from the current data. So you'll never see a bold prediction from an analyst estimate. If the analyst thinks the company may do well, they might project a few extra million for the next quarter. And in my process for growth investing mastery, I do like to use that run rate the most. And whether that's for price to earnings or for price to sales, I find that provides the most balanced approach. And one caution here is that we want to make sure we do apples to apples comparisons on whatever metrics we're measuring. So if we're comparing two companies, we want to make sure we're not comparing a trailing ratio to a run rate ratio or vice versa. Also, we don't want to measure adjusted values versus GAAP numbers on earnings, for example. And keep in mind that early stage growth companies typically have no PE or an undefined PE because they are not profitable yet. So for those early stage growth companies, we're typically using price to sales when we measure value in this way. Now let's look at why value is not a big part of my stock screening process. And this channel recently had a video about how I use a stock screener, but the topic of value did not come up in that video. And I got a few questions in the comments section why I'm not using value, as it would be really simple to add the PE ratio to my screener. And at first I was thinking deeply if I may have missed something in my process, but I do believe the approach makes sense to not look at value in a stock screener. And I'll put out a hypothetical example here. How much would we value the company with the following financials? They have revenue of 200 million, which is growing 50% year over year, and EBITDA of 20 million, with net income at 10 million. Your first instinct may be that you need some more information to know how to value this company, and that's the correct answer. Let's now look at some scenarios which could change the value of that hypothetical company. So we're still looking at the company that has 200 million of revenue, growing 50% year over year, and EBITDA of 20 million with net income of 10 million. How would the value of this company change if the industry was technology versus if the industry was metals and mining? If the company is a technology company, it could be worth potentially $20 billion in market cap. Whereas if it was metals and mining, it might be only worth $2 billion. So the industry a company's in could change the value dramatically. What if the guidance for this company was for 240 million of revenue in the next quarter, a 20% increase? Versus what if the guidance was only 205 million in the next quarter? The revenue pattern that a company has over the past year can dramatically alter the valuation of a growth company. In this first example, the revenue pattern goes from 133 million to 160 to 190 to 220, and then drops off a little bit to 200 in the latest quarter. So while revenue is technically up 50% year over year, on the previous quarter, revenue was higher, and it went down 20 million from quarter to quarter. In the prior quarters, the company had been adding about 30 million net new revenue per quarter. So this drop off looks fairly worrisome. In the next revenue pattern, revenue goes from 133 million to 140 to 150 to 170 and then to 200 million in the latest quarter. And this pattern is much more attractive overall because we see the geometric acceleration in the revenue growth. This company added 7 million of net new revenue and then 10 million of net new to 20 million net new and then to 30 million net new revenue in the latest quarter. So that's where we can really see that geometric acceleration and why we prefer the second revenue pattern versus the first one. Let's consider how the narrative could vastly change the valuation of a company. For example, in the latest earnings transcript, the company may have said they signed a record number of customers. Or they could have said customers dropped from a newly introduced regulation in the quarter. So, based off what a company is saying in the earnings transcript, it could change the value of a company quite a lot. And when we're using something like a stock screener, we have no way of knowing the narrative or the subjective aspect which comes up. Some concluding thoughts are that we prefer recurring revenue and platforms versus one time sales. And we need a comprehensive look at a company to determine its value. That includes looking at the numbers, narrative, product, and the guidance they're giving. And the screener simply is not capable to give us a full picture to determine the proper value of the company. And keep in mind that a stock that is overvalued today could be in value territory later if the stock price goes down or if the company keeps delivering good results. So we don't want to rule out a company too early when we see them in the screener. Let's discuss ruling out story stocks in our approach. We can use valuation in the screener to rule out pure story stocks. For example, NewScale Power came through the screen with a market cap of 9.8 billion and year-over-year revenue growth of 870%. Just based off those numbers I saw, this sounded like a very promising opportunity potentially. However, clicking into the financials, I saw the current quarterly revenue is 13.4 million with EBITDA of negative 35 million and net income of negative 14 million. Additionally, the revenue pattern was very weak as well. It went from 1.4 million to 1 million to 0.5 million, then jumped up to 34.2 million, and then to 13.4 million in the latest quarter. So just 3 quarters ago, this company was barely selling anything. And then they started selling about 34 million worth of product a quarter ago. But then sequentially it dropped back down to 13 million. Yet with only 13 million of revenue and losing a lot of money, this company is worth almost $10 billion. And the stock is a pure play story stock on the nuclear sector. So a lot of valuation for this company comes from forecasting future scenarios where nuclear takes a bigger part in the energy sector. And some tips here are that we want to short circuit research on companies which are not delivering results yet. Our approach requires that we have both numbers and narrative. So if we just have a strong narrative, we're not able to invest in this company. While the company may have a strong and promising story, we really need to see some earnings and financial accelerations. And we can always pass on a company if the valuation just doesn't make sense to us. Let's look into some success stories with using value in growth investing. And sometimes a dream scenario comes up where a stock is both a strong growth stock and a strong value stock. And the value here provides a figurative floor for the stock price because the company is still growing. If the company keeps executing and growing, then the value gets better. And usually this happens very rarely when the market does not understand the company at all. And one recent example is with Supermicro, who is in the computer server business, a business which was previously thought to be commoditized. The business was growing fast, but the market refused to pay a premium for it. However, the market can only ignore results for so long before a stock explodes higher on strong results. Additionally, when a stock starts to make a run, momentum investors pile into the stock, causing it to sometimes overrun on its value. And my story with Supermicro is that I first bought shares at $109 per share in April of 2023. And I looked up these numbers and dates again to make sure I got the details right. And in the most recent quarter at that time, revenue was up 58% year over year, and the company was seeing AI tailwinds in the results already. Supermicro earned adjusted EPS of $3.26 per share, which was up 271% year over year. And that beat the top end of the guidance on EPS, which was $2.90. Yet somehow the PE ratio for this company was only 6.8, which was incredibly cheap for a technology company. And just 1 year later, some of those shares were sold at over $1,000 a share, or over a 10 bagger in terms of results. And I did have some initial concerns on Supermicro when I first got into them surrounding export controls, as they had violated export controls once. Additionally, they did have some financial accounting issues some years back, and they said they had fired those people. However, if you know the story of Supermicro, they did run into real accounting issues recently, and they had rehired some of those problematic financial people. So I didn't end up selling all my shares at that really high price of over $1,000 a share because the stock did crash after these accounting issues, and I sold my shares after that. And one strategy here, when a company looks like both growth and value, and it might seem too good to be true, is to try and figure out why the market is bearish. And this can be a really strong use case for using AI tools such as Perplexity. For example, we could say Supermicro only has a price to earnings ratio of 6.8. Explain to me why this company is so cheap. And that's when Perplexity might come back and say some investors are concerned about export controls or financial accounting. Let's look at another success story where we used a concept called relative value to figure out the value of a company. And in this case, we're looking at the company Astera Labs. And I included a graph here. The company went public in March of 2024 at about $80 a share. And that graph there doesn't show values for the y axis, but I wanted to show the boom and bust nature of the stock price over the last year and a half. And sometimes a stock can have strong value based on relative prices of where the stock was previously. And Astera Labs had a ton of hype about it when it went public in March of 2024. A lot of hyperscalers and prominent investment banks were the backers in the IPO process. However, the stock debuted at 80 and then it quickly crashed to $40 on AI based fears. And I started building my position in this company around $45 a share. I was confident to build my position quickly as the relative value was strong. It was previously at $80 a share and it went down to $45 a share. And I was careful to check the company had impressive earnings each quarter, and there was no obvious reason the price had been cut in half. We do want to be cautious about companies which are trading down because of some big news. So, relative value works best when there's no news about the company. And Astera had a huge run up to $148 a share at some point. However, the stock crashed once more on the 1 2 punch of DeepSeek fears and tariff fears combined. Yet, interestingly, their earnings always delivered strong results, and the company's always raised guidance since they went public. The stock has already lived through 2 hype cycles since the start of the IPO, less than 2 years ago. And one caution here is we want to avoid mixing up relative value with price anchoring. And price anchoring is a pretty powerful psychological phenomena. So, with price anchoring, sometimes we'll remember the price when we first learned about a stock. And if we learned about this stock when it was $40 a share, and then it goes up to $100 a share, we're sometimes inclined to think the stock is really expensive. However, the increase in share price doesn't necessarily mean it's a worse value. The company could have delivered really strong results or raised guidance significantly, which improves the value of the company. Let's look at another success story using valuation, which was with industry comparison. AppLovin and The Trade Desk are both in the ad tech space. In Q2 of 2024, the companies presented a huge contrast on valuation. The Trade Desk had a market cap of 50 billion, while AppLovin had a market cap of 25 billion. And with the Trade Desk having twice the market cap of AppLovin, you would expect the Trade Desk to have stronger financials or a more promising narrative. Yet the Trade Desk had 585 million of revenue, which was up 26% year over year. And AppLovin had 1.08 billion or 1080 million of revenue, which was up 44% year over year. And looking at EBITDA, the Trade Desk had 116 million of EBITDA, while App had 500 million of EBITDA in Q2 of 2024. And for net income, the Trade Desk had 85 million and AppLovin had 310 million. Meanwhile, the Trade Desk had a price to earnings ratio of 173, and the price to earnings for AppLovin was just 29. So we can see here AppLovin had more revenue, a higher revenue growth rate, almost 4 times as much EBITDA, and about 4 times as much net income. However, the price to earnings ratio for AppLovin was significantly lower than the Trade Desk. And even analysts were asking the AppLovin CEO about how come the market doesn't respect your results. And that can be a really strong indicator of a coming price rise when even the analysts start mentioning that this company seems really cheap or they can't understand the valuation. At the time, mobile game ads were viewed by the market to be worth less than traditional ads. Additionally, the company, The Trade Desk, had a much more serious sounding name than AppLovin. And the stock prices since then show the power of using industry comparison. AppLovin went from $75 a share to current prices of around $384 a share, while the Trade Desk was at $85 a share back in Q2 of 2024, and now they're currently at $72 a share. One more success story with valuation comes from a scenario where the value on a stock seems too low. And sometimes we can see the market cap of a stock or the value, and it just makes no sense to us because it seems like it should be a lot higher. In this example, we'll look at the company Cloudflare. And I'd heard a lot about Cloudflare before the company went public. There was a joke on Hacker News that if Cloudflare goes down, the whole internet goes down. And the company had a really strong industry reputation. Developers loved the product, and that was in contrast to other SaaS products, which developers often complain about. Cloudflare was set to go public in 2019, and I knew nothing about the company's revenue or profitability, but I expected this company's market cap to be over $50 billion dollars based on what I knew about the company. I was shocked to find out the company is much smaller and by an entire magnitude. Cloudflare was set to go public with a $5 billion market cap. And it just made no sense to me that a company said to be running the internet is only worth $5 billion. However, we do want to do our due diligence still, and we want to validate the numbers are accelerating. We don't want to buy a stock simply off the fact that it seems like it should be bigger, but it is a very strong sign that the company may be a promising investment. And 2 years after the stock went public, it went from $20 a share to over $200 a share. However, we should keep in mind this coincided with peak SaaS valuations in 2021. The stock did crash in stock price since then, but as of today, the valuation is $63 billion for Cloudflare. Let's now get into some failure scenarios where I misuse valuation. And the first example is where a company has too much hype. The company Snowflake went public in 2020 with a ton of hype in the SaaS space. Net retention rate, or NRR, for the company was the highest in the industry, being over 150%. And the company did a really great job marketing themselves. They said, "We're not a SaaS business, we're a consumption business." And they made that sound better than the rest of the SaaS companies. However, when we look at the financials that were in their S1, revenue in the latest quarter then was 133 million, which was up 121% year over year. While that sounds impressive, EBITDA was negative 75 million and net income was negative 78 million in that latest quarter. And somehow the market valued this company at $80 billion on its debut trading day. When the company finally went public, it traded up to $240 a share on its first day, or triple the price that it was set to go public at. And even Warren Buffett succumbed to the hype and bought into his first SaaS stock. And he did get in on that pre-IPO price of $80 and got an immediate triple. And this is one of the reasons I'm somewhat critical of Warren Buffett's returns, is he gets in on these deals which aren't available to individual investors. For myself, I was willing to pay whatever price because I thought this company was so promising and they had some of the best metrics of any SaaS companies in the industry. But looking back now, it was insane to have an $80 billion market cap for a company that's losing $78 million on 133 million of revenue. And nearly 5 years later, the company is still below its 2020 IPO price, with the latest quarter having negative 430 million of net income. Another failure scenario which can come up when valuing a growth stock is when people say there's a new way to determine value. And I've seen this happen twice before. Once in 2000 when I bought into the Munder Internet Fund. And I only had a few years of investing experience at this point, so I was really new to investing. This was the hottest internet fund from the internet boom, and they had commercials all the time on CNBC. I started believing in all the hype that the internet would take over everything, that valuations are no longer important, and that the technology itself is incredibly valuable. And I wasn't even selecting individual stocks, I was just betting on the whole sector. But maybe somewhat predictably, the fund lost over 90% of its value and was then disbanded. And this mutual fund also charged high fees on top of the catastrophic losses it produced for its investors. In another scenario, about 20 years later, SaaS valuations reached all time highs, and price to sales ratios were well above historical norms, even for high tech companies. And I ended up ignoring all the warning signs here. As many predicted, these companies will be so huge by 2030, who cares what price is paid right now? However, the industry was really hurt, and it was for two factors. One was interest rates went way up, and that was combined with CTOs and CFOs' scrutiny on SaaS spending, and both of those really hurt the industry. Additionally, there was a big curveball in 2023 with AI, and some companies such as ZoomInfo lost almost all their value. ZoomInfo was a fast growing SaaS stock, and they were like a CRM for getting corporate information. For example, one of their users may want to get information on how to contact a C suite member at another company. But AI tooling made it so that you could just ask AI the same questions, and ZoomInfo's product lost a lot of value. Looking back and thinking deeply why I ignored the warning signs, I'd had so much success in SaaS over the past decade, and I wasn't diversified, and I was also blind to the risks. And something to keep in mind is that when stocks are going up all the time, the talking heads will be saying you have to buy in, and that may give a sense of security. But once things start going down, those same talking heads will say how obvious it was. Everything was overvalued, and they saw it so clearly. And it's usually best not to listen to these talk shows or watch CNBC at all because they give you a lot of misinformation and bad advice. They love to use these catchphrases like cash is trash or cash is king. So when the market's going up, cash is trash and you should be fully invested. But as soon as it starts going down, those same speakers start saying how great it is to have cash. Let's get into some common mistakes that growth investors make with value. And the first one is not doing apples to apples comparisons. When we start doing comparisons between different companies or industries, it requires that we use apples to apples comparisons so that everything is accurate. What that means is that PE or PS ratios should be measured the same way, whether that's trailing, run rate, or forward looking. So we wouldn't want to compare a run rate price to sales versus a trailing price to sales, for example, on two different companies. And we need to make sure to compare GAAP versus GAAP numbers and adjusted versus adjusted numbers. And adjusted just means non GAAP numbers. The company should say whether a metric is GAAP or non GAAP, but sometimes a company will state at the beginning of our earnings release that all the metrics they're going to talk about are non GAAP. So you do want to pay attention to that part. And one warning is that comparing GAAP versus adjusted for technology companies will create a big distortion. And this is because technology companies have a lot of stock based comp. And you want to find out if your data provider is giving you GAAP or adjusted numbers. For example, in Robinhood, when it shows the expected EPS that a company is going to deliver, that's an adjusted number they show. And you just have to know that. But in Koifin, which is the main data provider I use, they default to GAAP numbers. And so you want to be really careful comparing those. And the conclusion is that valuation metrics must be on an apples to apples basis. Otherwise, a critical mistake is being made. Another common mistake that growth investors may make on value is looking at PE on companies which just turned profitable. So, a growth company which just turned profitable is going to have a high PE ratio no matter what. So, sometimes we might see a PE ratio of something like 2000 and immediately assume the company's massively overvalued. However, we should remember that a company that is not profitable has an undefined or no PE ratio. And when a company crosses into that threshold of profitability, it's always going to have a high PE ratio. Here's an example which demonstrates that. And we're looking over the past year of net income for a hypothetical company. 4 quarters ago, they had negative 20 million of net income, and the next quarter they had negative 10 million. After that, they had 10 million of net income and 21 million of net income in the latest quarter. However, the company's trailing net income over the last 12 months is just 1 million when we sum up all those numbers. And if the market cap for this company is $2 billion, then the price to earnings ratio is 2,000. And we get that by doing 2,000 divided by 1. The 2,000 there is just converting the market cap 2 billion into millions. So one of the key takeaways here is even though the trailing PE is 2,000 for this company, it does not mean it's overpriced. And with growth investing, we want to compare PE ratios on more mature companies, which have already been profitable for a while. But if a company is really early stage, then the price to earnings ratio could be meaningless if they aren't profitable yet. We also want to look at the trend that the company is in. And in this hypothetical company, the trend is really positive as net income has improved a lot over the course of the year. 4 quarters ago, it was negative 20 million. And in the latest quarter, it's positive 21 million. So that's a dramatic turnaround on profitability. And finding companies which are crossing into the threshold of profitability is a good strategy for us. One more common mistake with value and growth investing is becoming a value investor after the poor performance a company shows. Many times a company will post disappointing results and the stock price will get crushed. The mistake for the growth investor is to now focus on the value. And this often happens when an investor falls in love with a company. They might be really impressed by the CEO or the company itself, maybe they use the product. So what happens is the investor ends up bunkering down. And the same investor refuses to accept the poor results, and they may even increase their position. The key mistake the investor is making is refusing to accept they were wrong and then reevaluate the situation. Here's an example of this common mistake. Company A has posted sequential revenue growth over the last 2 years. However, in this latest quarter, revenue dropped off sequentially, and this caught investors off guard. The stock ended up dropping 50% on the news in the earnings report. Yet, investors who love this stock will be able to find all the silver linings possible. And they might say something like, it should not have dropped this much. Or maybe a 20% drop makes sense, but definitely not 50%. And the investor may compound their mistake by doubling their position, as the value looks a whole lot better from their perspective. One more common mistake in growth investing regarding value is projecting value far into the future. We do not want to estimate financials longer than 1 year out, and guessing where the company could land next quarter is okay. However, a company is only as good as its last posted earnings result. We do not want to do a lot of guesswork or predictions within our strategy. And some examples of this mistake might be saying things like, by 2030, the TAM is expected to grow to this amount, or saying, projecting the company's discounted cash flows out 5 years, they're going to be X amount. Additionally, using forward-looking metrics such as forward PE relies on lazy analyst extrapolation techniques. And the key takeaways are that we want to allow the company results to dictate our actions, and we want to stop trying to guess or predict what will happen next, because that will lead to disappointment. Our guesses will always be biased, and we'd rather rely on objective results that the companies are posting instead. However, we still need to put on our subjective and imaginative hat for the narrative part of the story, but we don't want to try and guess financials too far into the future. Let's now look at some strategy with value in growth investing. And the main one is adding and trimming based on value. Both adding and trimming on value is an essential part of our strategy. And this portion of the strategy needs to be applied to our top high confidence positions. Our lower confidence positions may not give us the confidence to add on drawdowns. For example, if we're unsure of a company that we own and it goes down 30%, we may not feel comfortable adding more there. However, our higher confidence positions we can add to when the price gets depressed on no news, knowing that the fundamentals and narrative are strong. And when our high confidence positions have a big run up, it offers a chance for us to trim those positions and add to other higher confidence positions, which may have not gone up as much. We can also trim a higher confidence position to increase a smaller allocation position or start an allocation in a newer stock as well. And this strategy only turns into a failure strategy if we start adding to companies on poor results. The key here is to add to our positions on no news for a depressed stock price when our conviction in this stock is high. And large green bars up are the best opportunity for us to trim a stock, but it's also the hardest to execute. And sometimes you'll see a stock's up 10% and it keeps ticking up, and you have this inclination that it's going to keep ticking up, so you're hesitant to sell. However, that's often the best time to sell when it's ticking up like that. And keep in mind, we still want to let our winners run, and we're just trimming here, and that's usually trimming less than 5% of that total position. Let's wrap up with some concluding thoughts about the role that value plays in growth investing. Valuation is a key part of our growth investing strategy. And valuing a growth stock needs to account for objective analysis, such as numbers and guidance, but also subjective elements, such as the narrative. And we need a comprehensive view of a company to know its value. We prefer simple metrics like price to earnings and price to sales, to evaluate our companies. And we want to use different ways to determine value depending on the situation. So we may use the relative value of the stock price, or we may use industry comparisons. We want to avoid guesswork and predictions whenever possible. And we need to be careful about some of the pitfalls with valuation. One of the big ones being an overvalued industry that's said to be measuring value in a new way. And another one is becoming a value investor on a poor earnings report. And when we use value effectively, it allows us to add or trim our positions with high confidence. Ultimately, we let company results dictate our actions. This concludes the video on valuing a growth stock. If you enjoyed the video and you want to stay notified, subscribe to the channel or leave me a like or comment below. As a last reminder, this is not investment advice or recommendations to buy stocks. Thank you.